I feel like one of the unfair expectations we set for ourselves as adults is that we automatically understand all the confusing financial terms out there. At our first job, we sit down with the HR manager, and as he or she goes over all the 401k options, we try to look like we know what they're talking about. You start talking to another dad at your kid's soccer game, and as he talks about how he's planning to start funding his Roth IRA, you nod your head along trying to show that you understand what he's talking about. And we kick ourselves for not knowing. Well, I'm here to tell you not to be so hard on yourself. 401ks, IRAs, Roths, these are terms that are thrown around in the personal finance space. So today, I want to go over the basics of what these retirement savings plans are so that next time you're at your daughter's ballet recital, you could be the one jabbering about how you're thinking about rolling over your 401ks to an IRA. Trust me, your fellow parents won't be annoyed at all. They'll actually be impressed. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, a channel dedicated to helping the second generation reach financial security. In this video, I want to demystify the retirement savings plan. Tax advantage accounts, 401ks, 403bs, IRAs, Roth IRAs. I'll go over each one in detail, but if you want to skip ahead to a specific section, please feel free to do so using the link in the description below. I'll also go over my quick 4-step order of investing at the end, so feel free to jump there if you want the quick takeaways. Alright, first let's start out with some fundamentals. When I talk to people about 401ks or IRAs, people often confuse them as investments themselves. Rather, we should think of 401ks or IRAs as buckets that hold the investments that we choose. And these investments could be single stocks, actively managed mutual funds, or my favorite, low-cost index funds. And these buckets are quite important because by putting our investments into these designated retirement savings plans, we're able to take advantage of tax benefits provided by Uncle Sam. And Uncle Sam wants you to invest money to these buckets so you can be financially ready for retirement, thus all the tax benefits. You can still have investments outside of these buckets, but they won't be able to take advantage of the tax benefits provided by the retirement savings plans. They can be broadly categorized as ordinary buckets versus the tax advantaged buckets. For the purpose of this video, I won't be talking about ordinary buckets, but we'll focus specifically on tax advantaged buckets. One thing to note is that tax advantaged buckets doesn't mean you avoid paying taxes. They don't eliminate your tax obligations. I'll explain more in detail later in the video, but just know that you'll definitely pay less but still pay some taxes when you're using these buckets. The timing of when you'll pay taxes will differ based on the type of accounts that you use. Also, there are penalties for trying to access this money early. Currently as it stands, you'll pay a penalty if you withdraw before the age of 59 and a half. Alright, now that we've covered some fundamentals, let's dive into specific buckets. I'll cover the most common employer-based retirement savings plan, the 401k. If you have a traditional job, most often they'll have a 401k as part of their benefits package with loads of other benefits like healthcare, disability insurance, and or wellness support. There is also the 403b. These are offered to employees of public schools and certain religious or charitable organizations. For simplicity's sake, since 403bs are similar to 401ks, I'll refer only to 401ks throughout the rest of this video. Tax advantage. For me, the most obvious reason to contribute money to a 401k is the tax advantage. For a 401k, when you make a contribution, you can deduct that amount from your income for tax purposes. For 2022, the contribution cap is $20,500 per person per year. Add another $6,500 to that if you're 50 and older. If you're fortunate enough to be in a higher tax bracket, this benefit is huge. Let me show you an example. Let's say that for 2022, you're fortunate to be making more than $83,550 combined as a family. The marginal federal tax rate is 22%. If you contribute the max amount and your contribution can lower your taxable income level to below this bracket, then you're saving $4,510 in taxes, 22% of $20,500. Essentially, instead of paying $4,510 in taxes, you're putting that money into the market to work to grow your net worth. Of course, you need to pay taxes when you withdraw, but that initial contribution is tax deductible and the growth is all tax deferred until you withdraw. And as I stated earlier, any money withdrawn before 59 and a half is subject to penalty, so make sure you do your best not to touch it before then. Another thing to note is that after you turn 70 and a half, your money is subject to RMDs, required minimum distributions. I won't go into too much detail here, but just know that you will eventually need to withdraw your money from this account because Uncle Sam will eventually 1. Your taxes. Investment options. The investment options will depend on the investment company that your employer is working with, and the investment company will narrow down the investment options for you. Most plans that I've seen have a range of actively managed funds, target date funds, and some index funds. If your investment company happens to be Vanguard, then you're in luck. You can choose from a selection of low-cost index funds. My favorite is VTSAX if your company offers it, but you can't go wrong with most of its low-cost, well-diversified index funds. However, even if Vanguard isn't your investment company your employer has chosen, that's okay. Most 401k plans should have at least one index fund option. Make sure to check the expense ratios though. This was the case for me. My company was partnered with Fidelity, but thankfully there was a S&P 500 index fund with a pretty low expense ratio that I was able to go with. For some reason, you don't see a low-cost index fund as an option, it may be time to talk to your HR office. Match. If your employer is nice, they'll also offer a match to your contribution. This can range from 3 to 6%. What this means is that if you make $100,000 annually and your employer matches up to 5%, then when you contribute your 5%, $5,000, your employer will also contribute their 5%, another $5,000. This is free money. If your company matches, make sure to invest at least up to the match. Rollover. In today's economy, it's rare for someone to stay with one company throughout their career. So when you leave your current employer, know that you can roll over your 401k into an IRA, preserving its tax advantage. Some employers will allow you to continue holding the 401k in their plan, but if you want more control, know that you don't need to keep your money in there. Roth 401k. Some of you guys might have heard something called the Roth 401k. It wasn't available at a lot of places before, but I've seen it being made more widely available in the last few years. This will make more sense when I review Roth IRA in the next section, but the main thing to note here is that everything else being similar, investment option, withdrawal penalty, etc., contributions you make are not deductible from your income for tax purposes. My recommendation is that if you're in a higher income bracket where you're paying a pretty sizable amount in taxes, you should opt for a traditional 401k so you can save money in taxes and be able to invest more in your accumulation phase of life. If you're enjoying this video so far and you want to learn more about personal finance and navigating life as a sandwich generation, I would appreciate it if you could subscribe and hit the like button because that would really help out the channel. Let's move on to individual-based tax-advantaged buckets. IRAs, individual retirement accounts. Unlike in employer-based tax-advantaged buckets like 401k, these are not tied to your employer. You have complete control over them. This could be good for some, maybe bad for others, I hope not. I'm a control freak, so I personally love these IRAs. I can select the investment company I want and the investments that I want for my IRA. There are many types of IRAs, but for simplicity's sake, in this video, I'll cover the two most common ones, the traditional IRA and the Roth IRA. Let's start out with traditional IRA, or also known as the deductible IRA. Contribution limit. For 2022, the contribution limit is $6,000 per person. Add another $1,000 if you are 50 and older. And this is separate from your employer-based plan limit. So if you're hardcore in 2022, you can essentially max out your 401k and another $6,000 with your IRA. You could be putting $26,500 into the market annually and double that if you're married. Tax deductible. Like a traditional 401k, contributions you make are deductible from your income for tax purposes. So again, if you max out your $6,000 and you're in a 22% tax bracket, you could be saving $1,320 from going to Uncle Sam and rather be going into your investment, growing your net worth. But this deductibility is phased out over a certain income, so make sure to check the IRS website for the latest updates. I'll have a link in the description. And similar to a traditional 401k, while all the investment growth is tax deferred, you'll need to pay taxes when you withdraw your money. Money drawn before 15.5 is subject to penalty, so practice caution. And after 70.5, your money is subject to RMDs as well. The second type of IRA I want to discuss is the Roth IRA. The key difference between the Roth IRA and the traditional IRA is the timing of their tax advantages. With traditional IRA, you deduct contributions now and pay taxes on withdrawals later. Roth IRA works the opposite. You pay taxes up front, but you don't have to pay taxes on your withdrawals. However, note that eligibility to contribute is phased out over certain income levels. So if you feel like you'll be hitting the ceiling eventually, consider investing in a Roth as soon as possible so you can take advantage of the tax-free withdrawals. The great thing I like about Roth IRAs is that not only are all earnings on your investment growth tax-free, all your withdrawal after 59.5 are tax-free. Unlike a traditional 401k or a traditional IRA where you know you'll need to pay Uncle Sam his taxes down the line, you're free and clear with a Roth. Another thing to note is that you can withdraw your original contribution anytime, tax and penalty free, since you've already paid taxes on them. But I recommend refraining yourself from doing this because you want that contribution to compound. Alright, if you stayed with me so far, congratulations. Before I go over my recommendations and how to approach these plans, let me quickly summarize what we just went over. 401ks. Immediate tax benefits and tax-free growth, but taxes are due when the money is withdrawn. Roth 401ks. No immediate tax benefit, tax-free growth, and no taxes due on withdrawal. Traditional IRA, immediate tax benefit and tax-free growth, but taxes are due when the money is withdrawn. Roth IRAs, no immediate tax benefit, tax-free growth, and no taxes on withdrawals. Eligibility to contribute phases out over certain income limits. To simplify your takeaways, my 4-step recommendation for filling these buckets would be in the following order. 1. If your company has a traditional 401k match, fund it until you get the match. This could be 3 to 6% based on your company's offering. Fund it up to the match percentage. 2 is fully fund the Roth IRA. This is $6,000 per individual for 2022. If you don't have one yet, you can easily open up one with any brokerage company of your choice. Of course, my favorite is Vanguard. 3, after maxing out your Roth IRA, go back to your 401k and fully fund it to the max. And 4, if you still have money available to invest, this is when I would recommend you open up a taxable brokerage account to invest your money in. But do this only after you've maxed out all your retirement savings plans. There you have it, guys. If you found value from this video, please hit the like button, leave a comment, and subscribe to the channel so that you don't miss out on any of my other upcoming videos. I firmly believe that being part of the Sandwich generation doesn't have to mean financial stress. With careful planning and preparation, we can thrive during this stage of life. Help me spread knowledge. Thank you again. I'll see you in my next video.